everyone, welcome to China Market Connect. Only 2 weeks into the new year, we have already witnessed some noticeable market volatility. Increasingly hawkish signals from developed market central banks put upwards pressure on bond yields, seemingly causing a growth to value rotations in equity. This week, we'll explain to investors why we recommend to stay invested in China growth stocks for 3 reasons. Number 1, China growth stocks, particularly the offshore internet sector, is attractively priced and offer better performance catch-up. China reversed from having a bad start in history to worst performing equities in 2021, underperformed MSCI All-Country World Index by 68%. Today, the internet sector is priced at 18 times of earnings after a provoked earning downgrade, mainly driven by regulation issues that compared to US growth at 39 times of earnings, that's massively discounted relatively. In 2022, regulation clarity will help to compress left-tail valuation risks and facilitate the potential return to a strong organic growth for the sector. Historically, the growth premium in equity will expand amid an easier policy and a slowing but normalizing economy. We believe both conditions are met in China this year. In order to avoid potential systemic risks and better manage macro stress, Chinese policymakers will have to step up in 2022. We expect policy rates to stay low, fiscal policy to turn more expansionary, and more targeted liquidities injections to SMEs. China tends to have idiosyncratic nature in policy makings, though this ease may sound incremental but necessary, particularly ahead of key political events this year. We studied historical pattern between GDP growth and equity style performance and find during an accelerating GDP growth period, value stocks tend to outperform. If GDP growth starts to decelerate, but in finding a settled range, the dispersion is less noticeable. However, if GDP growth normalized in a relatively lower but stabilized range, growth stocks tend to outperform. The same trend also observed in the United States. Given our macro expectation is China to stabilize its GDP growth at around 5% from 2022, together with a supportive liquidity conditions domestically, that is a combination bode well for growth premium expansions. This gave us the comfort to prefer growth-oriented equities in China for 2022. This is Xiaolin Chen. Thank you for watching China Market Connect. See you next week.